Hello and welcome back to the Base School, where we make accounting standards simple and practical. Today, we're looking at IFRS 15 revenue from contracts with customers. This standard answers one of the most important questions in accounting: when should a business recognize revenue? And the answer is based on a clear 5-step model. First, let's define it. Revenue is income arising from a company's ordinary activities, like selling goods, providing services, or granting the right to use assets such as royalties. IFRS 15 applies to all contracts with customers, except for leases, insurance, and financial instruments, which are covered by other standards. The 5-step model. Now, here comes the heart of IFRS 15, the 5-step model for revenue recognition. Step 1. Identify the contract. A contract is an agreement between two or more parties that creates enforceable rights and obligations. Example: a customer orders 100 laptops from a supplier. That's a contract. Step 2. Identify the performance obligations. Performance obligations are the promises in the contract to deliver goods or services. Example: delivering the laptops is one obligation, providing a 1-year maintenance service is another. Step 3. Determine the transaction price. This is the amount of consideration the company expects to receive. Example: the laptops cost £100,000, but the contract includes a £5,000 discount if payment is made early. The transaction price is adjusted accordingly. Step 4. Allocate the transaction price. If a contract has multiple performance obligations, the transaction price must be allocated to each obligation based on their standalone selling prices. Example: out of the £100,000, maybe £95,000 relates to laptops and £5,000 relates to the maintenance service. Step 5. Recognize revenue. Revenue is recognized when, or as, the company satisfies a performance obligation by transferring control of goods or services to the customer. Example: revenue for laptops is recognized on delivery because control transfers at that point. Revenue for maintenance is recognized over time, as the service is provided. For example, let's bring this to life with some examples. Retail sale. You know Tesco stores? If Tesco sells groceries, revenue is recognized immediately at checkout. Construction contract. Balfour Beatty builds a bridge over 2 years. Revenue is recognized over time, as progress is made. Software license. A company sells a one-time software license. Revenue is recognized up front, but if it includes support over 12 months, revenue is spread over that period. A few important points to remember. If payment is received before goods or services are delivered, it's a contract liability, deferred revenue. If goods or services are delivered but payment hasn't been received yet, it's a contract asset or receivable. Variable consideration, like bonuses, discounts, or penalties, should be estimated and included in the transaction price, only if it is highly probable that revenue won't reverse. Contract modifications or changes in scope may require reallocating the transaction price. Significant financing components. If payment is deferred or advanced, adjust for the time value of money. Let's wrap up IFRS 15. It gives us a 5-step model for revenue recognition. Identify the contract, identify performance obligations, determine the transaction price, allocate it, recognize revenue when obligations are satisfied. Revenue is recognized when control passes, either at a point in time or over time. Always watch for contract assets, liabilities, variable consideration, modifications, and financing components. Remember, IFRS 15 does not apply to leases, insurance, or financial instruments, which follow their own standards. So, whenever you think of revenue, think of the 5 steps. They're your roadmap. This is the Base School, simplifying accounting standards one lesson at a time. Stay tuned for our next episode.